Silver is moving into a zone where the math starts forcing behavior, whether the headlines admit it or not. And here is the conflict. The loudest voices will try to frame this as a speculator ES dream, a bubble, a meme, a nothing burger that will fade the moment it gets uncomfortable. But the market doesn't care what anyone calls it when the plumbing tightens, the curve flips, and the cost of getting metal right now starts talking louder than the spot quote. Because if this one setup holds through the next couple of weeks, you're not looking at a cute rally anymore. You're looking at a structure that can reprice violently in steps with air pockets in between. And later in this video, I'm going to give you a clean checklist, levels, triggers, and the one metric that will tell you whether $130 silver is fantasy or an actual path the market can stumble into. Not someday, not in a decade. The math starts getting loud when the right doors close, and some of those doors are starting to swing right now, but that's not the part that matters. The part that matters is where the pressure is hiding. Let's ground this before we get cinematic, because metals only reward people who anchor to reality. As we sit here in the first week of January 2026, silver isn't a little higher. Silver has been living around the low 70s after one of the most aggressive, attention-grabbing runs in modern memory. If you've been watching the tape, you felt it. The days that feel like silver is weightless, then the days where it drops like gravity got turned up. And that emotional whiplash is not an accident. It's a feature of a market where leverage exists, where margin is a weapon, where liquidity thins faster than people expect, and where paper and physical can briefly disagree in a way that forces someone, somewhere, to pay up. And that's where the real pressure starts. Because in silver, the biggest move isn't the move you see, it's the move the market has to do to reconcile its own contradictions. Now, about that $130 number, you've seen it tossed around like a dare, like a flex, like a thumbnail number designed to trigger your curiosity or your skepticism. Good. Stay skeptical, but don't dismiss the number just because it's a big number. The reason $130 keeps popping up is not purely hype. It's because one ratio, one compression, one reversion that has happened before in different regimes can spit out a number that looks insane until you realize the inputs aren't insane at all. Here's the simple version. Silver often gets discussed through the gold-silver ratio. How many ounces of silver to buy 1 ounce of gold? That ratio expands in risk-off moments and compresses in moments when silver runs hotter, when industrial bid gets louder, when speculation gets crowded, and when the market starts to price scarcity instead of comfort. If gold stays elevated, let us say it stays in an institutional bid regime, and the ratio compresses to levels we've seen in past cycles, the implied silver price can jump fast. That's not prophecy, that's arithmetic. And arithmetic has no feelings. This move isn't emotion, it's math. But here's the twist. Ratios don't compress politely. They compress in bursts. And those bursts can turn into reflexive loops, where price itself becomes the catalyst that forces more price. But that's not the part that matters either. The part that matters is what tells you the ratio is compressing for a real reason, not just because the crowd got excited. So where do you look? Not the headline, not the influencer, not the breathless to the moon chatter. The hidden detail in silver is the spread, it's the curve, it's the market's internal pricing of time, because spot price can lie to you in the short term. Spot price can be dragged by paper flows, by short-term hedging, by a single forced event. The curve is harder to fake for long. When the curve starts behaving differently, it's the market telling you what it's actually struggling with: time, inventory, and immediacy. And once you see that, you can't unsee it. Let me make backwardation feel real, because this is one of those concepts that sounds academic until it steals your sleep. In a normal world, future delivery costs more than immediate delivery. That's contango. You pay a little extra for time. Storage, insurance, financing. Makes sense. But in a stressed market, that flips. Near-term delivery costs more than later delivery. That's backwardation. And backwardation is basically the market whispering, then shouting. Immediate metal is the scarce thing. Not theoretical metal, not a promise. Metal you can actually access now. And when backwardation shows up in a precious metal, people should pay attention, because it implies somebody is willing to pay up to solve a near-term problem. And when somebody is paying up to solve a near-term problem, somebody else is short that problem. And that's where the real pressure starts. Now, why does that matter for you, the retail investor, the macro watcher, the metals person who doesn't trust institutions? Because backwardation forces behavior. It forces roles. It forces decision-making. It forces the people who are used to papering over tightness to confront a cost. Think about it like this. If you come out a short silver via futures and the market is backwardated, rolling that short can become expensive. If you're an industrial user and you need metal, the forward curve telling you later is cheaper doesn't help if your production schedule is now. If you're a trader financing metal, lease rates and borrowing costs can jump, and suddenly the economics of carrying inventory change. This isn't a mood, it's a set of constraints. But that's not the part that matters. The next detail is what flips the whole setup: the calendar. Early January is not just another week. It is a time when flows that didn't care about your opinion hit the market anyway. Thin liquidity, new positioning, fresh risk limits, and this is key: mechanical index rebalancing windows that can shove size through futures whether anyone wants to or not. In early January, certain commodity indices rebalance. That doesn't mean some shadow committee decided silver should go down. It means rules-based funds follow rules, and those rules can produce forced selling in one area and forced buying in another. This year, the window that matters sits in that January 8th to 14th zone. And here's why that matters. If billions of dollars of systematic money have to adjust exposure, that flow can temporarily push price around, especially in a market like silver, where liquidity can vanish at the worst moments. So you can get a dip that looks like the bull case is dead. But it might not be dead. It might be a forced event. And forced events often create the best tells. Because if the market absorbs forced selling and holds key levels, that's not weakness. That's strength with proof. And that's where the real pressure starts. But there is another lever institutions love because it doesn't require a press conference: margin. Silver is a margin market. Leverage is the accelerant. And when things get too hot, exchanges can raise margin requirements. That's not a conspiracy. It's risk management. But here's the effect. Raising margin forces participants to post more cash to maintain positions. Some can, some can't. And when they can't, they liquidate. That liquidation isn't a change of mind. It's a funding event. It can crush price fast, even if the underlying thesis is still intact. We just watched a margin hike episode around late December that reminded everyone how quickly silver can be used against the weak hands. And that's exactly why you have to frame this correctly. Price can whip around violently, even if the thesis is correct. Volatility can be used like a psychological crowbar to pry conviction out of you at the worst possible time. But that's not the part that matters. The part that matters is what happens after the shove. Because silver isn't just a chart, it's a supply chain, and supply chains don't respond instantly to price. Here's a fact that changes how you think about, can they just mine more? Most silver supply doesn't come from a miner waking up and deciding to produce more silver. A lot of silver comes as a byproduct of mining other metals: lead, zinc, copper. That means the silver supply response is constrained by decisions made for other markets. Even if silver goes vertical, it doesn't mean silver output suddenly doubles. The system has lead times, capex cycles, refining constraints, recycling limits, logistics friction. So when demand surges, the path of least resistance is not more supply tomorrow. It's higher price to ration demand or pull metal out of hoards. And that's where the real pressure starts. Now, demand. This is where the story separates the tourist from the serious. If silver demand was only jewelry sentiment and coin shop vibes, you could dismiss it as cyclical emotion. But silver demand has a hard industrial core: electrification, electronics, solar, chemistry, solder, conductivity. The modern economy uses silver because it works. And when industrial demand is strong, it's not optional demand, it's input demand. Companies don't say, we'll skip this because the chart looks frothy. They hedge, they procure, they substitute only if they can, and substitution isn't always easy or immediate. So when you hear that industrial demand has been robust and that deficits have been persistent in recent years, don't treat it like a fun statistic. Treat it like structural friction. Persistent deficits don't guarantee a straight line rally. They guarantee tension. And tension gets resolved through price and volatility, but that's not the part that matters. The next detail is what turns tension into acceleration: inventories. Everyone loves to point at big vault numbers and say, see, there's plenty of metal. That argument is emotionally comforting, and it's often financially useless. Because in commodities, exists is not the same as available. Vault holdings can be large and still not solve a delivery problem if that metal is in the wrong form, the wrong place, the wrong ownership status, or simply unwilling to move at the current price. In stressed moments, the market learns the difference between metal in a building and metal for sale. And when the market is forced to discover that difference, spreads move first. Lease rates can jump, borrow costs can spike, the curve can flip, and suddenly the spot price has to catch up to the reality that the market is paying a premium for immediacy. This is why, in real tightness, the curve becomes your lie detector. And that's where the real pressure starts. Now layer in policy risk, because the market is not trading in a vacuum. Starting January 1st, 2026, China rolled out an export licensing regime that matters for a wide range of materials and supply chains. You don't need to assume the worst to recognize the impact. When the market has to price permission and bureaucracy, not just production, it can create uncertainty premia. It can change trade flows. It can change who holds inventory and where. It can make industrial buyers more nervous, which changes procurement behavior. And procurement behavior in a tight market is the spark that turns a steady bid into a panic bid. That's not the part that matters. The part that matters is how the arbitrage system reacts when one hub gets tight. Because in theory, arbitrage smooths everything. If prices differ between regions or between physical and paper, traders buy low and sell high until the gap closes. That's the textbook. But reality is a truck, a ship, a refinery slot, and a calendar. You can't teleport silver. You can't refine instantly. You can't fabricate bars or industrial forms without capacity. And when the market tightens, those frictions matter. Arbitrage tries to pull metal across the world, but timing turns that pull into a price shock instead of a gentle adjustment. That is how you get episodes where the paper price says one thing and the cost of sourcing immediate supply says another. And when those two disagree, something has to give. Usually it's price. Sometimes it's volatility. Often it's both. And that's where the real pressure starts. Now let S bring this back to the question everyone actually cares about. How does this turn into triple-digit silver? Not with a straight line, not with a clean trend, not with your favorite influencer calling it every day. It happens when multiple layers stack at once. Mechanism, data point, institutional behavior, on-the-ground symptoms, global comparison, market structure signal. And you need at least 5 proof points to take it seriously, not just one. Proof point 1, the curve and the cost of time. If you continue to see episodes of backwardation, elevated borrow costs, or persistent near-term tightness signals, that's a structural tell. It says, the market is struggling with immediacy. Proof point 2, the supply response constraint. Byproduct supply means the market can't simply flood itself with new silver quickly. Tightness can persist longer than people think, especially if other base metal cycles aren't aligned. Proof point 3, industrial demand and procurement behavior. When industrial users hedge and secure supply, they can pull demand forward. That creates near-term stress. It shows up as premiums, lead times, and curve distortion. Proof point 4, policy and trade flow uncertainty. Export licensing regimes, geopolitics, and reserve behavior can change how metals are held and moved. Even if nothing breaks, the uncertainty itself can alter inventory preferences. Proof point 5, forced flows and risk controls. Index rebalancing can shove the price around. Margin hikes can create liquidation cascades. Those two together can create violent swings that look bearish on the surface but are actually tests of absorption. Now here's the extra layer, options. Because in silver, once price approaches big round strikes and open interest clusters, options hedging can change the shape of the move. Let's simplify delta and gamma without turning this into a textbook. When traders buy calls, the dealers who sold those calls often hedge by buying the underlying as price rises. That's delta hedging. If the option exposure is concentrated and the market moves into the strike zone, hedging can become reflexive. Rising price forces more hedging buying, which pushes price higher, which forces more hedging buying. That's the gamma effect people talk about. It doesn't always happen, and it doesn't always dominate. But when it does, it can turn a grind into a surge. And that's where the real pressure starts. Because if silver pushes into a zone where dealers are short gamma, the move can speed up in a way that feels like the market snapped. But it wasn't magic. It was hedging mechanics colliding with thin liquidity. So you're sitting there thinking, okay, but $130 still sounds insane. Good. It should. You should feel resistance to it. That resistance is what keeps you from getting reckless. The right way to think about $130 isn't, this will happen. The right way is, under what conditions could the market plausibly travel there? And those conditions are not mysterious. They're observable, they're mechanical, and they come with invalidation. Here's the 2-scenario lens that keeps you sane, because this market will try to break your psychology. Scenario 1, controlled pullback and retest. You get a dip, maybe driven by rebalancing flows, margin stress, profit taking. Price pulls back into a support band. It churns, it retests. The curve behavior stabilizes. The market proves it can absorb selling without collapsing. If that happens, the bull case doesn't need drama. It needs structure. And structure is built through retests and higher lows. But that's not the part that matters. The part that matters is whether the market keeps whispering tightness while price consolidates. Scenario 2, continuation squeeze and gap risk. This is the one that makes people rich and ruins people at the same time. Price doesn't give you the neat pullback. It rips through resistance, triggers stops, forces short covering, and accelerates as liquidity thins. In that scenario, gaps are real. Weekend risk is real. Overnight repricing is real. And if you are positioned wrong, the market won't give you a polite exit. So if you're watching for it, you don't watch with greed. You watch with respect. Because if this one level breaks, the math changes. Now let's talk levels in a way that's practical and not pretend precise. You don't need 100 lines on a chart. You need a few zones where behavior changes. With silver living around the low 70s, you should be thinking in bands. The high 60s, low 70s region matters because it S the zone where a lot of recent trading psychology sits. Breakout memory, dip buying reflex, and is the move real? Emotion? If price dips into that region and snaps back quickly, that's a tell of demand underneath. If it breaks and holds below with conviction, that weakens the near-term setup. Then you've got the high 70s as an obvious pressure zone. It's a psychological round number neighborhood where resistance tends to appear, where options can cluster, where headlines get loud. If price clears that zone and holds it, you're not just trending. You're changing the market's memory. Then you've just got the prior peak zone, the low to mid 80s area that has acted like a ceiling in recent months. If the market can break that and then do the most important thing in trend trading, hold it on a retest, that's a powerful confirmation. Because it means the market is absorbing profit taking and forced flows and still maintaining structure. And that's where the real pressure starts. Because once you move past those zones, the next resistance isn't just a line on your chart. It's the market's ability to source metal and manage risk. Now let's address the skepticism head on, because the skeptics are the ones who survive. The counterpoint is simple. Silver can collapse even in a bull thesis. Demand can soften. Growth can slow. Substitution can increase. Policy fears can fade. Inventories can become available at the right price. And most importantly, positioning can unwind. If the market gets too one-sided, it becomes vulnerable to the exact volatility weapons we discussed: margin hikes, liquidity vacuum drops, and forced selling cascades. So what do you do with that? You don't deny it. You build your invalidation. Here's what weakens the $130 path in the near term. If the curve normalizes decisively and stays normal, meaning the urgency premium collapses and price is not making higher highs, that's a sign that tightness pressure is easing. If borrow costs and lease rate stress fade without price strength, it suggests the market found relief. If price repeatedly fails at key resistance zones and starts printing lower highs, that's a classic trend warning. If industrial demand signals start clearly deteriorating, real demand destruction, not just a one-week scare, that matters. And if the policy and trade flow concerns recede and metal starts moving freely again, risk premium can compress. None of those mean silver is dead forever. They mean the path to triple digits is not active right now, and discipline is what keeps you from paying tuition to the market. Now, the viewer psychology shield, this is where most people fail. Silver will try to emotionally manipulate you with speed. It will move in a way that makes you feel late when you're early and wrong when you're right. It will spike and convince you it's unstoppable, then drop and convince you it was all a trap. That's the game. And if you react to every wiggle, you will become liquidity. So here's how you protect yourself. First, separate trend signal from noise. Trend signal is structural. Higher highs and higher lows, break and hold above resistance, supportive curve behavior, evidence of tightness and demand persistence. Noise is intraday volatility, headline-driven spikes, and margin-driven flushes that reverse quickly. Second, respect leverage. If you're over-levered, the market can force you out, even if your thesis is correct. Third, plan your response before the move, not during it. Know what level would make you reevaluate. Know what retest you want to see. Know what you'll do if you get a violent drop that is purely mechanical, because when it happens, you won't be thinking clearly. And that's not a moral failure, that's biology. But if you plan, you don't have to be heroic. You just have to be consistent. Now let's talk about what comes next in the next 7 to 14 days, because this is where the calendar matters. The January 8th to 14th window is important, not because it guarantees anything, but because it can inject mechanical flow into a market that's already emotionally charged. Watch for volume spikes and abrupt moves that don't fit the narrative. Watch for whether dips get bought quickly or whether they bleed. Watch the behavior around those key zones. Does the market reclaim levels after a shove, or does it fail and grind lower? Watch whether the curve and the sense of urgency stays elevated or fades, and watch whether the market starts doing something very specific, breaking a resistance zone, then returning to it, then holding it. That retest is often the difference between a headline rally and a structural re-rating. Here, as the checklist that tells you whether the move is real without you needing to be a hero. 1. Price breaks and holds above the major resistance zone, not just tags it. 2. A pullback, if it happens, is controlled and bought, not panicked and extended. 3. The curve continues to show signs of stress or tightness when price is strong, not only when price is weak. 4. Industrial demand narrative remains intact. No clear evidence of collapsing end-user demand. 5. The market absorbs forced flows from rebalancing and risk controls without losing its structure. If you see those, then the $130 number stops being a meme and becomes a possible path. Still uncertain, still volatile, but no longer absurd. But that's not the part that matters. The part that matters is your behavior when volatility tries to bait you. Because silver's biggest trick is the fake out. The flush that makes you sell the bottom, then it rips. The spike that makes you buy the top, then it dumps. The gap that makes you chase, then it retraces. And institutions don't need to rig anything to benefit from that. They benefit because they understand risk constraints, and you don't. They understand margin, and you don't. They understand liquidity, and you don't. So your edge is not secret information. Your edge is structure and self-control. That's it. That's the whole game. Now let's connect the dots to the triple-digit path one more time, but in a way that stays honest. Silver at $130 would likely require not one single catalyst, but a stack. Gold staying supported in a regime where institutions still value hard assets. The gold-silver ratio, compressing meaningfully persistent industrial demand-supply response constraints, staying tight, and a market structure moment where spreads and options mechanics accelerate price through resistance zones. In that world, the move doesn't go 72 to 130 in a straight line. It goes in bursts. It goes with shakeouts. It goes with "this is over" moments. And it goes with "I can't believe it did that" gaps. And the people who benefit are the ones who treat it like a process, not a lottery ticket. So what do you do if you own silver right now? You don't need to do something dramatic. You need to do something precise. You need to know your horizon. Are you a long-term holder who wants to write a structural story? Then your job is to avoid being emotionally forced out by noise. Are you a trader trying to capture swings? Then your job is to respect levels, respect volatility, and respect the fact that the market can change regime quickly around calendar events. Are you somewhere in between? Then your job is to choose a framework and stick to it, because indecision plus volatility is where people get carved up. And if you're skeptical and you're thinking, this all sounds like a lot of narrative, then good. Here's your non-narrative anchor. The market has to reconcile paper claims with physical constraints and time. The curve is a price of time. Borrow costs are a price of scarcity. Spreads are a price of urgency. Those are not vibes. Those are costs. And when costs rise, behavior changes. Behavior is what moves price. The story comes after. But that's not the part that matters. The part that matters is what you watch next. Over the next 2 weeks, watch the market's reaction to stress. Watch whether it absorbs forced selling. And watch whether it respects the key support band. Watch whether it can reclaim and hold resistance zones. Watch whether urgency signals persist. Watch whether volatility spikes are used to shake out weak hands and then reverse. And most of all, watch how you feel during it. If you feel euphoric, you're at risk. If you feel terrified, you're at risk. The market wants you in those extremes because that's where you make bad decisions. I'll give you one more practical tool, simple but powerful. When silver moves violently, ask one question. Did the structure break or did funding break? Structure breaking means the trend is changing. Lower highs, lower lows, failure to reclaim key zones, and easing tightness signals. Funding breaking means margin and liquidity forced a move that may not reflect underlying demand. Funding breaks often reverse quickly, but they feel like the end of the world in the moment. If you can tell those apart, you stop being the person who sells the bottom and buys the top. And that's the whole point. Now, if you're still listening, you're not here for comfort. You're here for a framework. So here's the subtle community move. Track this like a team, not like a gambler. When you see the curve behaving oddly, note it. When you see a level hold that shouldn't, note it. When you see a dump that gets instantly absorbed, note it. Share what you're seeing and compare it to the checklist, not to the hype. That's how you build trust in your own process. And in a market like silver, process is the only hedge against being emotionally harvested by volatility. Silver at $130 is not a promise. It is a path that becomes more plausible when the math forces behavior and the market S-plumbing refuses to relax. If the next couple of weeks show you absorption, persistent tightness signals, and a break and hold through major zones, you'll know the setup is alive. If instead you see curve normalization, failed breakouts, and structural weakness, you'll know the market needs more time and you don't have to force it. Either way, you win because you're not guessing. You're watching the right things, and that's where the real pressure starts on everyone who isn't.